Barrel rolls is the reporter thrown into the secretive world of the Forex Super Model, where nothing is as it seems. Beware the techno-monk, and steer clear of Professor Code and his two assistants. Give the senior trader a wide berth, and don't expect any sense from the risk manager.
Hello again, trading cats. I'm the risk manager at the Forex Super Model, and this is part 4 of economic videos aimed at traders specifically, but generally trying to get people up to speed on the macroeconomic transmissions through the economic system. Right, part 4 then, government spending and the budget position, national income and the balance of trade. We're also going to talk about the full multiplier at the end of it as well. So let's make a start then. We're going to start these as I write things up. But anyway, we're going to look at government spending and the budget position initially. Right, now if you remember, assuming G, government spending, is exogenous. Now what we mean by an exogenous variable is one which is outside a model, or the model in this case. Right, so it's exogenous or it's autonomous. Jargon again, economic jargon. Or if it's autonomous, and in this case it's not a function of income, because that's what our model is looking at, but an autonomous variable means it's not a function of something, but in this case it's not a function of income. Right, so we've said that G, remember where G comes from, it's government spending, and it's part of C plus I plus X plus G plus X minus M. Right, so then we said that an increase in aggregate demand, AD, aggregate demand, which we can also say is the same thing as aggregate monetary demand, which is also the same as GDP, gross domestic product, at market prices. Lots of initials and things to get used to, I know. But okay, so if you get an increase in aggregate demand, or GDP, this leads to a rise in the tax revenue. Right, so why does it lead to a rise in the tax revenue? Well, obviously, part of that increase will be maybe an increase in consumption, so you get increasing value-added tax, etc. So we get increasing taxes either from direct taxation, which is on income, or indirect taxation, which tends to be on expenditure, VAT. There are obviously other taxes, but these are the main ones. Right, and also if you get a rise in aggregate demand, and in other words that the expenditure function, the C plus I plus G plus X minus M, shifts upwards, then we get an increase in income and output, and then we get, therefore, more people in theory will be employed, so we'll have less welfare benefits, etc. So if we get a rise in aggregate demand, or GDP, we're going to get a rise in the tax base via direct and indirect taxes, and we're going to get a reduction in welfare benefits, leading to a general increase in our budgetary position. Now we can show this on this diagram here. Now on the vertical axis we've got G and T. Doesn't stand for gin and tonic, but it stands for government spending and taxation, or taxes, and this is the budget position, if you like. Now we can show that G is as a function is exogenous or autonomous. It's outside the system. G is government spending is likely to be based on the aims and objectives of the government in office at that time. And remember the economic objectives: stable prices, full employment, economic growth, balance of payments, stability, and the fifth one, effectively, a fair and equitable distribution of wealth and income. Right, so G can be viewed as autonomous or exogenous. It's not affected by income, but taxation is affected by income, because as people's incomes rise via an increase in GDP, gross domestic product, let's say we get increase in tax revenue and we get a fall off in welfare. So we've got this taxation function which sort of slopes upwards like this, and we've got the government spending function, which in any given point of time is horizontal. So if you look at this, where they cross, then you've got taxes being equal to government spending. We've got a balanced budget at that point, and before this point, this is government spending, which is higher than taxes. So the government's having to spend more than it's dragging in through taxes. It's got a budget deficit, and then we get equality where government spending equals taxation, and then as national income rises beyond that, we get a surplus, a budget surplus, because you can see that the taxation, the amount coming in through taxes is above the general government spending level. Therefore, we've got an increasing surplus. So just to, if a deficit is where government spending is greater than taxes, so it's this side, and a surplus is where taxes are greater than government spending, which is this side. And this is sort of an automatic stabilizer then on if you like, so on surpluses and deficits in the government budget. So we're going to stop it there and move on to the next thing. So see you in a minute. Right, welcome back, cats. Right, we're moving on to the next topic, which is national income and the balance of trade. Right, remember the external part of the aggregate monetary demand is the X minus M, exports minus imports, and the balance of payments is effectively the difference between those two. So here we've got we can show that the value of exports as a horizontal line, it's in the model it's believed to be exogenous, if I could say it, autonomous, which means it's not a function of income and it's outside the model. Whereas imports are believed to be a function of income, so you get this situation where as national income rises, people suck in more foreign imports. Good examples are things like German cars. Here in the UK, we seem to like to buy a lot of German cars, and therefore what happens is you get this situation because you've got this horizontal effect on exports, and you've got imports start to rise progressively as income increases. Then you get to the point where initially exports exceed imports, and therefore we've got a balance of trade surplus up until this point. Then we get a balance of payments equilibrium where exports equal imports at this point, and then beyond that, as income rises beyond that, we start sucking in these imports, which, for example, things like cars and whatever, washing machines, French wines, whatever you want, and therefore imports start to exceed our exports, and we get a balance of trade or payments deficit beyond this point. And so it's a two-edged sword, as you can see from the government perspective of having an objective. That's why they want a stable balance of payments. And if you generate economic growth via consumption, you're likely to get a deterioration in the balance of payments, all things being equal, as economists say. Now you can show this in another way when it's net exports. Well, net exports is the difference between exports and imports, and you can see that our equilibrium point here is there. So we've got a surplus in net exports here, where exports are greater than imports. Then we've got equilibrium, and then beyond this income point we've got exports less than imports, and so we've got a deficit. It's the same but different. So that sort of ties in with that then. So we've looked at the government's budget situation, which is the G part, and we've looked at the external balance, which is balance of payments, which is the X minus M, how that is affected by changes in income. And remember that all these things are affected by changes in leakages and injections. And we're going to move on shortly to look at the full multiplier within the Keynesian model. So stop it there, see you in a minute. Right, welcome back again. Right, we're going to talk about the Keynesian multiplier on the different sectors of the economy. So remember the basic two-sector economy, households and firms, H&F. Households consume or save their income, and firms generate investment in the model, so I. Right, so we've got the leakage here from the households to the savings. So, and we talk about the marginal propensity to save or to consume. In other words, how much of every extra pound is, what proportion of that is saved or consumed, etc. So the basic multiplier then on the two sector is the reciprocal of 1 minus the MPC, which basically in simple terms is 1 over the MPS, marginal propensity to save. In other words, if we consume 80% of our income and we save 20%, so the marginal propensity to save is effectively 0.2, so 1 over 0.2, the multiplier is 5. So that's a two-sector economy. And then if we add the third sector, the government sector, our leakage is taxation, because that reduces consumption. So the multiplier is the reciprocal of the marginal propensity to save plus the marginal propensity to tax. So, and then finally on the fourth sector, so we open it up to the world, we export and we import, X minus M, our leakages are imports in this case, so the marginal propensity to import is relevant. So the full multiplier is the reciprocal, or 1 over MPS, marginal propensity to save, plus MPT, marginal propensity to tax, plus MPM, marginal propensity to import. That gives us the amount of leakage which generates a certain degree of multiplier, which when multiplied through the economy in various successions of expenditure rounds decide how much of the initial injection or the additional injection, say in government spending, is multiplied through the economy. And just remember, it basically works the other way. You can have a downward multiplier as well. So we're just going to stop that there and we're just going to finish up in a minute. Right, welcome back cats again. Let's look at this then. So what determines the size of the multiplier? Well, there's many factors, but these are some of the main ones. Change in interest rates then. So if you get a rise in the interest rate or a fall in the interest rate, if you get a fall, it's going to encourage consumption, or it may go the other way. If you get a rise in interest rate, it'll choke off consumption and increase savings. People get higher return on their savings. Change in taxation then. If you increase taxes, you're sucking out more income from people, less expenditure, etc. So that's going to be less consumption, and therefore the multiplier will be smaller. Change in imports then. If you get a rise in imports, that's going to be a reduction in our multiplier, because effectively we're passing part of our national wealth to another country for their exports. Right, so determinants of marginal propensity to import then, and here we are. We've actually got to almost to where we want to initially in the macroeconomic model, because determinants of the marginal propensity to import then, and that's how much of every extra pound a consumer spends on imports. Right, so it's the relative price between countries. Now here we are then, this is the big one, the exchange rate, FX. This is links with our trading directly then. So the determinants of the marginal propensity to import is the FX rate between, say, the euro and the dollar or whatever. Next one, speculation. Again, relative to trading. We are speculators. This is what we do. So speculation has a large effect. Interest rate differentials. Right, so if for example America has a relatively strong interest rate differential compared to, say, Japan, then you're going to get a flow of hot money, so-called hot money, in the form of capital flows going towards the United States, the USD effectively. So, and the final one, the quality of the goods and services. If your country's goods and services are of inferior or quality or better quality, then it will have a bearing on your imports. So for example, if in Britain we had a period where towards the back end of the 70s where our cars were noticeably of inferior quality, and it was the rise of the Japanese car in England, because our goods and services, effectively, people were prepared to buy Japanese cars because they were viewed as a superior product. They didn't rust so much, they were more reliable, they had better features, etc. So there you go. That's a whistle-stop tour of where we are. Now, we're finally getting together enough jargon and experience in the economics theatre to be able to move forward to part 5, which is going to be how we get these transmission mechanisms through the other systems. So we're going to be looking at Keynesian liquidity preference theory and how it transmits, so it's the theory of money, how it transmits through asset classes within the Keynesian mechanism. So watch out for that, that will be part 5. Hope this has been useful. See you again soon. Thank you.